Welcome back to On Deck by Haversine Funding, the podcast where we dive deep into insights, trends, and strategies that drive success in this unique space. Today, we have our second episode. We're really excited about that. Brought back Jen Merritt, the president of Haversine Funding. She had too much fun on the first episode, so we had to bring her back for another one. And none other than Cole Harmonson, the owner at Dare Capital. Cole, thank you so much for joining us.
Glad to be here. Thank you guys for having me.
Yeah, definitely. So, Cole, we really wanted to have you on and kind of dive deep into one of the topics that keep coming up in conversation with other lenders that we're seeing is the challenges that everyone is experiencing in this unique space. It's different than any past trends that we have seen, to say the least. And I think a lot of people could benefit from hearing from a business owner's perspective, someone that has been in the industry for a long time, like yourself and Jen as well. And then additionally, someone who is newer to the space like me and the different challenges that we're seeing, what the new innovations that are popping up in the industry and some of the solutions that have worked for you in your past and that you plan on utilizing here in the future. So, Cole, I think we could start from the very beginning and tell us a little bit of how you got into the space and your journey to where you are now.
I started in factoring in 1994 for a bank out in El Paso. And in 96, I started a factoring asset-based lending group for a bank here in Austin. Been in Austin ever since. And then we sold that in 2007, started another company called Far West, sold that in 2018, and then was lucky enough to get to partner with Deborah Zukonik in 2019 to start Dare.
Yeah, that's an interesting journey. You know, you've it seems like everyone kind of slips into the space, and once you're in it, you just don't leave. So, Cole, what were some of the challenges that you experienced getting into the industry from your initial introduction to factoring, and then also what were some of the challenges when starting Dare that you experienced?
I mean, getting into the industry in '94 is a lot different than getting into the industry today. Back
Yes.
in back in the day, we were sort of coming off the '80s and all the credit crisis that happened then. So I just happened to benefit from the knowledge of some really smart bankers focusing on cash flow, focusing on collateral management, focusing on, basically the things we do, which is take care of customers and manage the risks that we have.
Right. And so when starting Dare,
How is it different than
yeah,
from before?
right.
Yeah.
Well,
It's not a trick question. I
I,
just know things are different. It's hard.
as you know, we've all been hanging around the IFA for a long time. I think
Yes.
there were, 25 people at the meeting in 1996, and today there's like 800 people.
Yes.
So the
Mhm.
proliferation of the product, I think, speaks, you know, very well to what the product does for customers. It's different today in that, I mean, we could just jump right into what I think the biggest challenges today
Yeah,
are.
let's do
Yeah,
it.
And I think that's this banking crisis that we're in that no one is calling a banking crisis yet. I'm
absolutely.
sure most of the factors that are out there have seen this, but we see deals getting kicked out right after the SVB debacle. That was the first wave, it looked like, of deals that are not financeable at all because of over advances or tons of inventory reliance.
Right.
Banks are still over advanced going into industries that they didn't really understand, going into industries that were started during ZERP and Burr. And I think those models are really being tested right now. And now it feels like we're starting to see clients that are coming to us that are much better on the credit spectrum. On this liquidity crisis that banks are facing, I think is a double-edged sword for factors. In general, I think it's going to be good for us over a longer term.
Mhm.
I think in the interim, in the next couple of years, it's going to depend on sort of what happens and what the Fed does and how the banking environment changes. But I think the days of easy credit that we've all been sort of wishing for, if you will, and looking at what the competitors are doing are over with, and I think factors are going to be very well served in the next couple of years.
When you say it's a double-edged sword on that piece, I know we're seeing as well, and all the lenders and factors we work with, they said the same thing. And earlier when everyone expected this big wave, credit wave to come in as far as getting new deals, those were not the same quality that everyone wanted. And I think we talked about this on our last podcast a little
Mhm.
bit, but now things have picked up. Banks are asking clients to leave and companies to go find a home elsewhere, or if one of the businesses needs a line increase or something like that, they can't help them. There was an article that was out today about approval rates within the alternative finance space being up 27, 29%, and bank approvals are down 13%. But that goes with more movement into this alternative specialty finance space for lenders and factors to take advantage of. Is the double-edged sword piece of that the fact that lenders and factors also need to find financing and need capital, or is it more on the existing companies within their portfolios that could be facing challenges? Or maybe it's all three things.
Well, yeah, I mean, obviously, you can't have a capital company without capital. So,
Right.
at the end of the day, you have to make sure that you're taking care of your senior lender, et cetera. But I mean, we are in a credit pickers market. We've been in a credit pickers market since the last 12 months, 18 months. We've been very conservative in the way that we've looked at things, just because it has felt like every leading indicator you can look at, with the most recent being, the deterioration in the freight market, is just one leading indicator. But, I won't sit here and go through all of them.
Right.
Mhm.
But it seems like we're due for a leg down in terms of valuation after a 40% run up in the last couple of years over every asset class you can think of. So, my thought process, and certainly Deborah's thought process around credit, is to be extra conservative, because I think we're going to continue to see banks looking for liquidity. So that's the double-edged sword. Is, yeah, we're going to have a lot more deal flow, but I think we have to be much more concerned with our concentration levels and
Right.
with the way in which we're extending credit, because I don't think this storm is over. I think this is just the beginning of it.
I would agree with that. Where, everyone is busier, but it seems like lenders are, adding into their underwriting processes, their account management
Right.
processes to gear up for those challenges so they can work through those deals properly, but also make sure you have the tools in place and the people in place to manage all of that, as there's more deals coming, right, from all that's going on. What would you say are important things for people to look at? I know last time we talked, it was, you can throw people at things, but
Right.
what are important things that you can share from, as long as you've been doing this? I'm going to say that because that's 1 year longer than me. Um, that would be helpful for people coming in the space or that are in the space and haven't been through something like this before. Like, what are things they can gravitate to, look at, um, technology, anything like that you can share?
Yeah, I mean, an expert is just a person who's made more mistakes in one field than anyone else. So, I feel like we've made as many as anyone else. I think each time we've had one of those, we tried to learn and put some belts and suspenders around the things that you need to pay attention to. So, everyone who gets into the space, who's not been a lender or in credit before, really looks at it as fairly simple. You purchase a receivable and it pays, right? You collect your money and you move on down the road.
Mhm.
And
Right.
we all know that
How
that's
hard can
not the
that be,
case.
right?
Yeah, the people think that it's an easy business. It's not, and so we really looked at it and said, hey, we have to boil down to the essentials, the non-negotiable things that, if you are claiming to understand your portfolio on a real-time basis, it's not actually possible given the technology that's on the market right now. So, spoiler alert, we're going to be introducing a software product that we think is going to be revolutionary for the industry because it's actually going to be able to track those things. But they're pretty simple. Anyone, again, people that have been in this business, we all know the things to do, but it's being proactive with your collateral, and it's being proactive with your clients, and being proactive, importantly, with your team. Because everyone knows when you scale a business, and that's what everyone who gets in this space wants to do. They want to scale their portfolio
Hmm.
so they can grow it, so they can realize a premium, so they can have basically a machine
Successful exit, right?
Right.
Yeah.
cleanses capital for we are part of the banking system in some way, right? So I can dive into some of those things, but essentially it's being proactive and being able to get all of the information out of the day-to-day transactions that happen within factoring are not they're not something that you could just put in the trash can. And also, the old way you did it was with spreadsheets and relying on one person and saying to that person, "Hey, how's it going over there in that book?"
Is everything
That's,
going
yeah,
Meanwhile,
it's
okay?
different day and age now.
Right.
right. Meanwhile, sort of, back in the day, it was just those spreadsheets, but you can actually glean a lot of information. We built a back end tool, and it was able to give us these analytics around notification, verification, and identification to things that, we would all look at: concentrations, dilution, days to pay, dilution
All
over
the
days to
important
pay.
aspects when
Uh,
evaluating your portfolio.
yeah, all those important aspects. And so we're excited about that. And from that perspective, it's understanding that operational risk is just as much a risk as credit risk is. So everyone, in the finance business goes and builds these giant credit packages, and they look great, but if you can't execute, within your team, that's another issue. So being able to communicate and scale your business, you have to have that information at your fingertips, and you have to be able to react quickly. We know in factoring, it's not like, oh, we can wait till the end of the quarter and get the borrowing base and we'll go back and,
Right.
Right.
we'll just be able to turn this ship. You can't do that.
Absolutely.
You can't do that in factoring.
And that's, that's really exciting news about the software. I think that's something that the
I'm
industry
excited to see it.
needs and is ready for. You were able to collect all the information that you've learned over the years and kind of curate your perfect potion, something that you think is very important when evaluating your book of business and what's important to see for business owners or portfolio managers or whatever the role may be. One thing that you did mention that I kind of want to touch on is when scaling your business, going into
Hmm.
the challenges, because that's something that a lot of industries and specifically our industry are facing. Those challenges is scaling with the banking in combination with the banking crisis, higher interest rates, higher cost of capital. So could you kind of dive into how you navigate those waters with the more expensive cost of capital, but yeah, if your book is or performing and you're actively growing, those challenges with scaling, you have the capital challenge, and then you also have the hiring new employees, onboarding them. So could you kind of walk us
Hmm.
through how you work those challenges out?
Yeah, I mean, so when you're scaling, to me, that means, or again, what I've learned again from mistakes is that, instead of having goals, instead of having outcomes, you have systems and you have processes that you follow religiously, and that you make sure that you're paying attention to those processes and the habits and the actions and the effort that goes into each one of those things, versus saying, we want to have a perfect portfolio, or we want to close X amount of deals. So it's finding whatever those metrics are that are important for your business and then following those. And again, if you can't communicate that to your team and you can't monitor and manage that, then the execution just won't be there. So
Mhm.
if you're going from 0 to 100 million in NFE, or whatever your goal is as a factor, or as an ABL lender, you really need to have that firm foundation of understanding what it is that we do. And again, it's easier. So I'm more predisposed to the sales side, and that was one of the reasons why, is because you can understand how many calls people make,
Mm,
you can
Mhm.
understand how many proposals are put out, what gets accepted, what gets funded, and why it doesn't. But on the operations and credit side, it's more like a black box that you throw things into, and then 30 days later, oh, did the invoice pay? Again, that's why we took each one of the silos of the things that are very, very important to operations and broke that down. And in the world of hybrid today, you can't necessarily be in the same room
right.
with everyone all the
Mhm.
time. So everyone has to understand, where are you? Where's the book today? What are we doing about it? Who is responsible for doing what inside of your book? And if you have a way to manage that, great. And we've all belt and suspended our way around figuring out ways to do that. Salesforce, other CRMs,
Right.
all kinds of systems, but people get, it's overwhelming, if you have to go log into 12 things, and it's
Yeah.
just busy work.
We see lots of because we work with so many different lenders and factors, but we'll see people that don't have any key performance indicators that they're looking at, and some people have so many that
It's
I don't
almost
know how
counterproductive.
you would be able to measure that.
Mhm.
And then you got to, like you said, you got to pull out what is important. And it's interesting because being proactive is a big thing. And I think the tools, you need to have all that information today, because when someone looks at, let's sit down once a month and go over the portfolio. I mean, we do it, everyone does it. But when you're doing that, you're looking at the past, right? And so you can see what's
Right.
happened, and just so you understand kind of what the trends are historically. But that's not going to help you with today. When you think about an entire portfolio for a factor turns over what, 30 to 45 days, somewhere in that range,
Yep.
depending on the
Right.
industry. So if you wait a month later, all the invoices you bought last month, who knows where they are now, unless you have current information, technology, things like that. And there's more stuff coming out all the time. And y'all, I'm excited to see what y'all are gonna create, or
Yeah.
what you've created that you're gonna launch. So
Yeah, I mean, the other thing is, like, having that real-time data is way better than having the bias that you get from people. And it's human nature, it's normal, it's confirmation bias. It's, hey, yeah, I know that there was a skipped invoice, or yes, I know that dilution over days to pay is changing, but we really like this guy. We believe he's going to perform. That's even if you get that information. So our thought process is, real-time data is way better than bias. And so if we're having our portfolio meeting, and we're talking about a particular client, we're not relying on someone's opinion about,
how they
what's
feel
happening.
about the
Mhm.
person or the
We're
relationship.
looking
Yeah.
at, okay, well, there was a skipped invoice. Why? What happened? It's also hard to know where to focus when you have 1,400, 1,500 clients. I mean, it's where are you going to start? And so having a risk score model, and having that, okay, that's the first thing we're going to talk about, is the biggest risk that we see based upon what just happened in the last week, not the last month, not the last 2 months, but the last week. And so now, can we go pull up a heat map and understand exactly, okay, this is the discussion. And further, again, if there's a solution to that, right? Okay, who's responsible for doing it? What are the next steps? So you can always stay ahead of that. So being able to do that is the thing that we've always strove for. And it's been a it's been very difficult to get that information and to be proactive, not just with your clients that you think are the riskiest clients, which is obviously the most important thing that you want to do inside of your book, but it's also to do on the other side of that, when you have great clients that you need to have conversations with, that are performing really well, and you want to understand their business. Can you get out ahead of those
Right.
conversations to
Mhm.
drive the outcomes that we promise? When we sit down with the client, we do a new deal with them, right? We're saying, hey, you're taking our expensive money, you're putting it back into your business. We need to make sure that it's actually, like, working for you and
Right.
doing its job.
What are
Mhm.
your
and
goals, and how
checking
can we help you get there? Right.
and checking in with clients like that is critical. That's one of the things that we said, okay, this is the most important thing. Everyone talks about it, but it's relationship. It's the relationship that you have with your customers, because that is going to also be very critical if there is a problem and your client knows that you didn't just call them when there's a problem. You
Right.
called them
Right.
all the time to discuss their business. And again, I think it's hard to know where to go unless you have that sort of direct information.
Mhm.
So we talked about it's going to get busier. We're going to need more systems. Hiring's tough right now in general as well. So those systems will help. Getting access to capital, measuring and performance. What are other things, if I'm just, I think what we're trying to do is feel like what can we do to share with those in the space, and what are key things when we're sitting around talking without being here, that we feel are important to talk about right now, or takeaways for the future.
I mean, the product that you guys came out with, the sub debt product
Hmm.
that goes
Mhm.
up to 95% of your NFE and really helps you as a
net
lender
net
or a
funds
factor.
employed, yes, 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 for
Yeah,
those that don't
net
know.
funds employed.
Yeah.
Um, that product should have been around in the market forever, because it really allows you to flex with your portfolio. Because that's one of the problems for smaller factors and not being able to take down a big chunk of sub debt, because you couldn't necessarily afford it until you had the NFE. It might cause you to go out and try to book deals maybe that you shouldn't in
Right.
that
Right.
world. And so, having a flexible product like that that also works with your senior lender and understanding their borrowing base requirements, I think is a genius product. We're customers, we're grateful for it. And, at the end of the day, it's kind of like, man, I wish this thing would have been around forever. But in terms of understanding, what you need to do with your capital, I think that's a great flexible product you guys created.
Thanks. No, we
Yeah.
appreciate that. And when we, prior factoring company, before we offered lender finance products, was, we had to go and we had our line of credit, we had to get sub debt, and that was just a set amount that we had to use all the time. And you're right. When your portfolio shrinks, you don't need it and you're paying more for it. So we tried to come up with something that requires some usage, but it does allow you that flexibility when you have fluctuations in your factoring portfolio, and we line it out so that we understand kind of the challenges. It's kind of like what you said. You want to get and understand your company's businesses and the business owners you work with, what they're trying to do, where they're trying to grow. So we created that so that we could help the people we work with get to where they're trying to grow to.
Mhm.
um, so we like it, and we have other stuff too, but I'm trying to think of other things that people do need help with. And I think some of the big takeaways I've heard you talk about, and I agree, is concentration's a killer. I feel like everything's a killer, right? Concentrations are something to watch out for and be paranoid about, honestly, especially when you have,
Absolutely.
I think, you talked about freight, and there's companies going bankrupt in that industry. And so if you had a big concentration with that, that would impact your portfolio.
Mhm.
Whether
And it's
that's,
things
yeah.
also that you go back a couple years ago. I mean, if transportation and COVID, hearing brokerages going bankrupt was something that was blasphemy. You would that was almost sold as these brokers aren't going to go bankrupt. Business is booming, and the groups that didn't take the necessary measurements prior to the downturn. I mean, they're paying the price. So, Cole, a lot of the things you touched on, are in preparation for when things are great, and also when things do take a turn. Those things are so important. I deemed it Cole's 6 famous non-negotiables.
Yeah.
It's funny. I think he
I
called his
think I think
company
one
that.
thing
Yeah.
what one thing for factors, especially if you're in the transportation market, to watch is this surge bankruptcy that's happening, which was a freight broker. And without going into the complete
Right.
details of it,
Mhm.
it's going to have ramifications on carriers' rights, which, as we know, they have always held a special place in the legislature's heart, because carriers have rights to go back on shippers and
Right.
get paid if the brokers don't pay them. And there are lenders that are asking, the bankruptcy court basically to not honor that time that we've been doing that forever, right? So that's been a time honored
Absolutely.
thing. So I think
Time honored,
if
meaning
you're
they're
in,
the ones that hauled the load. They should receive payment for their work. Yeah,
yeah, I
Absolutely.
mean, not only should they have
they have
a legal
historically.
right
Yeah.
to get paid, and so if that gets challenged, it's going to make the transportation factoring market a different place. It's already a different place, but I think that's just a great example of what's happening in credit in general.
Hmm.
The freight space, specifically the freight broker space, watching that go from in the last 10 years, adding 3,000 brokers, adding 8,000 brokers, and then 3,000 have closed their doors in the last year.
Right.
Yeah.
And so that's a very interesting development. I can only say it's interesting because we don't have a lot of money out in in
Yeah.
transportation right now. But it's a bloodbath, and as you know, there are a lot of great transportation factors out
There
there,
are.
Hmm.
and I think it's going to be an interesting case to watch.
Absolutely. Yeah.
Um,
We'll see what the future holds. Cole, once again, thank you so much for joining us. I think everything that you mentioned was awesome. I think everyone from people who are new to the industry, people that are experienced and been in the industry for a long time can take a lot away from this conversation. You've been in it for enough time to understand the hard times and the great times, and really build your business around that and the necessary requirements and all the challenges, and how you've come up with unique solutions and still coming up with unique solutions like your software. So I think we're all very excited for what the future holds for you and Dare. And thank you so much for joining us. The pleasure was all ours.
Thank you very much. Appreciate you guys having me.
Thank you, Cole.
Absolutely.
We appreciate it.
Thank you. Once again, thank you all for joining us on today's episode of On Deck with Haversine Funding. We hope you continue to join us on this journey, and everyone stay informed, stay inspired, and stay on course to growing your financial platform.